Thank you, and welcome to day 2 of our conference. My name is Eirik Haavaldsen. I'm head of research in Pareto. I actually do not focus daily on renewable energy, but on shipping and good old-fashioned steel. So, and we're going to have an oil session afterwards, and then we have a very impressive lineup today of both E&P companies and commodity shipping. But starting in Pareto, we always say that oil will be back, and the same goes for shipping. Obviously, shipping is back, and shipping is back again. Shipping always comes back, but it's a pleasure to say our 23 companies presenting here today in shipping. They've gained 60% over the past year. So they've gone from a combined market cap of $13 billion a year ago to 21 today. Which, when you compare it to the S&P 500 or the oil majors, or certainly the renewable majors, is a great outperformance, and of course extremely positive to see. If we look a little bit more in detail, the segments that have outperformed have been LNG and dry bulk. So versus January 2020, so before COVID, our sample here shown as Flex LNG, for example, up some 70%, including dividends. Gone up 3-4 times since the trough of Corona, and double over the past year. 2020 bulkers, so a real play on Capesize rates, have gone up 91% since the start of 2020. And this is the same for other dry bulk companies. When we look at the tanker names, they are down since the start of 2020, but we have to remember how 2019 was a year of euphoria for tankers, and in reality, they're actually higher than a year ago. So all shipping segments have actually done rather well over the past few years. And we see 3 reasons for this. First of all, we have cargo values. In shipping, there is a saying, if you're bullish on the vessel, buy the cargo as well. And of course, looking at the various commodity segments, it's been a phenomenal development over the past year, and particularly over the past few months. Natural gas is up 156% since the beginning of coal prices are up 156% since the beginning of 2020, a level we frankly never thought we would see again. Coal inventories are low across the globe. Demand is high. This is, of course, great for dry bulk shipping. Natural gas prices. Yesterday, I think there was a cargo sold into Asia of $26 per MMBTU, so that's more than $150 per oil barrel. So of course, commodity prices have gone to levels again we didn't really expect at this point. And of course, the development, as we've seen now in the newspapers over the past couple of days, has been tremendous in just the past couple of weeks. Oil prices are also up. I mean, they've doubled since our last conference, and yet they are lagging. They're lagging quite a bit versus other commodities and other hydrocarbons, which is, of course, a reflection of spare capacity, but this is setting a really interesting backdrop for the tanker segment, as I will get back to. So this is one reason. Cargo values are higher, obviously a reflection of stronger demand, but also a reflection of, also meaning that it's much easier to pay up for freight. The second thing we need to talk about is fleet productivity and fleet congestion, because this is huge. And I think what we've seen with COVID is that years of underinvestment also in port infrastructure is taking its toll on shipping productivity. So here to the left, we see the average dry bulk vessel. So this is all from 30,000 deadweight tons and up to Capesizes. On average, they're now spending 6 days more in port per voyage than what they did before COVID. So 50% up. 6 days, maybe, it doesn't sound that much, but 6 days, if you factor in how we're doing on average of 7-8 voyages per year, that's actually more than 50 days lost in congestion. So it's pretty significant. And the chart to the right is showing the deadweight tons of Capesize tonnage stuck in ports at all times. Again, it's gone from a low of around 80 million deadweight tons in 2016 to briefly above 110 million deadweight tons this year. So that's an increase of 40 million deadweight tons, and it actually means that 40% of the tonnage delivered between 2016 and now is just tied up in ports. So fleet productivity, port congestion, how COVID is shutting down activity and preventing cargoes from being discharged out of the ports, etc., is having a big impact on the global shipping fleet at the moment. Of course, the million-dollar question is how long will this go on? How much of this is created simply by COVID frictions and how much is structural? And we do not have the answer to that, but at least we see that the trend is still very strong and it's likely to last well into 2022. So fleet productivity is down sharply. I mean, if you factor in the number of days here, it actually means a drop in dry bulk productivity of some 10%, which is quite significant. You need to build a lot of vessels to replace that tonnage. The third factor, obviously, is fleet speed. And the fleet has slowed down in 2021, which is, of course, not what you would have expected given the strong market backdrop. We have an average speed now across the segments here. This is container ship, bulk carriers, tankers, and LNG carriers of around 11.3 knots. So it's down 20% versus the last time we actually had a good shipping environment. And it's also down versus 2015, 2016, when we also had a little bit of optimism. And this is not temporary. And where what our message here is that when you look at cargo values, it's a little bit temporary. It's unlikely that you will see gas prices in Asia of $26 per MMBTU for too long. Coal prices, the same. Fleet congestion is going to ease a little bit, but the fleet speed is temporary. And why is that? Because we have to, and I was hoping I didn't had to talk about decarbonization here as well, because there's a lot of talk about that. But we need to address the emission focus in shipping as well. The IMO, so the International Maritime Organization, they are targeting a reduction of 50% in CO2 emissions by 2050. They are the CO2 intensity, so how much CO2 you actually emit on a relative basis to your cargo movement, is going to be down 40% from 2000 well, basically today to 2000 from 2008 to 2030. So there is a steep reduction coming. But what is happening is, of course, the opposite, as is the case in a lot of these industries. Emissions are growing, increasing, and actually shipping's share of global CO2 emissions is going from around 2.6% today to 2.9% in 2030, unless we start doing something. And speed is, of course, the obvious solution. And this is why fleet speed, when you look at where we are, this fleet speed is unlikely to go up. If it was going to go up, it would have gone up by now because of the greater markets. So what will happen with these IMO regulations? Excuse me. From 2023, I mean, we all remember 2020 and IMO 2020 and scrubbers and the buzzwords. I think the buzzword scrubber will be nothing versus the buzzwords EEXI and CII. Because from 2023, as you know, we will have a class mark from the IMO. Every vessel will have to pass through an investigation, and will be facing certain targets and certain requirements in terms of CO2 emissions. This is a slide showing LNG carriers. So obviously their clients, oil majors, focusing on reducing their emissions, as we know. I've taken here just data from a previously listed LNG carrier owner, which owns vessels built 2006, 2013, and 2019. And you can see here the AER, so annual efficiency ratio, so how efficient you are in terms of cargo movement versus emissions. And there is a massive difference between old and new. So a steam carrier built in 2006 is more than twice as inefficient as a mega carrier built in 2019. And it also shows, as you see here, the pink dotted line. The IMO 2030 target is going to be impossible to comply for an old carrier. It's going to be difficult for a fairly old, and even the brand new equipment is just barely within the requirement. And this is interesting, and we're also already seeing charters talking about this, because obviously as an oil major, if your charter is an oil major, if your charter is a trader, you need flexibility. You need flexibility to speed up to deliver your cargo on time. And if you don't have that flexibility, your vessel is going to be unattractive. And of course, again, the typical message from investment bankers has always been that we need to build new equipment to replace old. And that's the case in shipping today. It's really the case. We can take any type of fleet profile, and you will get the same picture. A lot of vessels built up to the financial crisis. Certainly a lot of vessels delivered 2009, 10, 11, vessels ordered when things were good in 2007, 8. A lot of vessels built in 16, 17, but then also a lot of vessels built some 15, 20 years ago. On the crude tanker side, almost 40% of the vessels trading today are delivered before 2008, so before the baseline for these IMO 2020 regulations. 37% of the tankers will then struggle big time to comply with IMO regulations. So this means that as we head into 2025, 26, 27, we will actually need to replace 1/3 of the fleet, 40% of the fleet. It's difficult to quantify exactly, but it's certainly a big need. So what does this mean? It means that we need to start investing. This is global shipyards' monthly order intake. And of course, if you look at the share prices of some of the listed ship brokers, you will see this. But March 2021 was actually the best month for global shipyards since July 2008. So fantastic times. We actually had a lot of ordering. But it's not been tankers, it's not really been dry bulk vessels, it's been mostly container ships. So this means again that we have a shipyard industry that is suddenly bullish, suddenly confident. They have filled up their order books in 2023, they soon filled up their order books for 2024. So we are looking at now a couple of years where we need to replace to stay focused on emissions, but there is limited availability. Prices have gone up, and of course the fact that to talk about limited yard capacity as a shipping analyst is always dangerous. You always have a shipyard capacity popping up, but this time it's actually real, and we can see that from prices. Of course, if you ordered a tanker in 2018, you paid a VLCC, you paid 85. Today, 100. More. So prices are going up. You have inflation in shipyard prices, and you have limited capacity. So combining these stories, you have slower speed, you have port congestion across the segments, you have cargo values that are very high, and you have shipyard capacity that is quite limited. Then of course it's easy to be extremely optimistic on commodity shipping over the next couple of years. So we could have ended there, but I wanted to have a final point on oil tankers. So we have several companies presenting today, one right after Nadia, who's going to talk about the oil market in a minute. But we need to talk a little bit in detail about the oil tankers, because that's the only segment so far that is lagging, as we saw on the earlier slide. And this is technical. It might be difficult to see here, but it seems very strange to us, to me, that oil should be the only commodity where you actually have spare capacity, where prices aren't following. Demand will pick up. We're seeing flashes on Bloomberg now how India is starting to burn more fuel oil to produce power. And of course they will, because coal prices are higher than oil, gas prices are higher than oil. So far, as the chart to the left shows, oil trade, seaborne oil trade, hasn't really started to move. The dark blue line here shows the average. It's still down. It's still not turned. But what has turned has been products. So refined products trade, seaborne, has started to pick up quite actually rapidly over the past couple of months. It makes sense that refined products will move ahead of crude. You have end-user inventories. You have airports that need to restock. You have petrochemical facilities that need to restock. And as you saw also when COVID hit us in March of last year, the refined product trade dropped much quicker than the crude trade. So that's one thing. We're starting to see products pick up, and crude will follow not necessarily next week, not necessarily next month, but sometime over the next couple of months, we will see crude trade start to turn. And then, of course, the second question I get a lot now is why are oil tanker rates so weak when oil prices are starting to move and OPEC production is starting to increase? And that's a good question. OPEC production has started to increase. They are ramping up their production on a monthly basis now, but exports haven't, as the chart to the right shows. So OPEC exports, Middle Eastern exports, are still relatively flattish versus what they have been over the past 15 months. And this is perfectly natural because they're feeding their refineries, they're feeding their power production, etc. But again, when demand now starts to increase again, we're heading into winter season. We have alarmingly high gas prices and coal prices, as we said. Oil will follow. So I think with that, I'm setting the tone for a day of more oil talk, more commodity talk at our conference. And I'm happy to introduce our oil analyst, Nadia. She will give more color on the oil market.